I've been investing for around 14 years now. For 5 years of those, I've been a full-time finance content creator. I don't think that makes me any sort of guru or expert or anything like that. But I have had the honor of interviewing some of the best finance minds on the planet through my podcast. And today I want to try and distill down some of the best wisdom that I think I've picked up. Just to set my stall out, I buy a global index fund in the main, wide diversification across the whole global stock market. I don't think this is the most efficient, sexy, complicated, or even the best investment approach. It's just the one I do for the reasons that I'm about to set out in this video. Consider this like my guiding principles, if you will. If you do differ from me in terms of how you invest, all power to you. The best investment is ultimately the one that you stick with. Also, this video should not be taken as financial advice. I'm not your financial advisor, and while I talk about risk in this video, understand that all investments carry risk. The value of the funds that you put in can go down as well as up. But let's just start with, why do I invest? When I first discovered investing, it was like I'd finally discovered the thing that would set me free and make me rich. That desire for quick wealth led to mistakes and me losing money. And today, I see it a bit differently. The first reason I invest is to outrun inflation, to protect the purchasing power of the money that I've earned. But there is another reason. Time is my most valuable asset, as I can't create more of it. My labor then is also limited, because working essentially means trading your time for money. One day, I won't be able to work anymore, so I need to put the output of my labor into assets which I think have a good chance of producing long-term returns. That then those long-term returns in that pot can one day support me when my labor can't. I have investments in lots of different types of assets, but I use the stock market as the main vehicle to achieve this. The stock market to me represents a way to capture the output of human activity. I want a slice of that. I basically want to own a slice of the global population's labor. So investing for me is about outrunning inflation and then freeing myself from trading my time for money long term. Those two things shape the way I invest. The goal here isn't to swing for the fences, it's about protecting the output of my limited labor. So the worst thing I could do then really is piss it all up the wall, because I'll never get that back. That's why instead of focusing on the winners, I focus on the losers. In World War II, there was an American soldier who was trained specifically as a meteorologist. His name was Charlie. He was given the specific task of predicting the weather in Alaska. Now, Charlie was smart, and he realized pretty quickly that what he was actually being asked to do was to clear pilots for takeoff. If he said the weather was good, they flew. If he got it wrong, well, then men might die. Charlie didn't want that, of course, so he asked himself a question. If I want to kill as many pilots as possible, what do I do? He reframed the question, so he focused on the outcome that he didn't want, so then he could solve the problem from that way around. This type of thinking is called inversion. And Charlie Munger used it to save lives in World War II, and then go on to make hundreds of billions of dollars investing with his business partner Warren Buffett before he died. His business partner has two famous rules when it comes to investing.
The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule, and that's all the rules there are.
So let's invert that. If an investor wants to increase their chances of losing money, what should they do? There's this wonderful paper from JP Morgan named The Agony and the Ecstasy. They look at the entire US stock market between 1980 and the year 2020. That list of companies is called the Russell 3000, so if you see me mention the Russell 3000 again, you know that I just mean the whole US stock market. 40% of the companies that were ever in the Russell 3000 index experienced a catastrophic stock price loss. The authors of the paper define a catastrophic loss as losing 70% of value and never recovering. Almost half of the companies essentially collapsed in value and never came back. When we then plot the performance of the American stock market, and remember this is the most successful stock market on the planet over that period, we can see the normal is not winners but losers. More companies lose than win, shown by the fact that the median line for companies, so the middle company, is in the negative 10% mark.
If you just pick a few stocks at random, the odds are stacked against you. You're more likely to lose than win from a few randomly chosen stocks.
That's Hendrik Bessenbinder, and he did a similar study into stocks and their returns, but he stretched it out a bit. He went from 1926 to 2016. 26,000 companies he studied, and he found that 1,000, just more than 4% of those companies, delivered all of the returns. So what's the best way for an investor to lose money? Well, if you look at the data, it's by buying individual companies. The odds on you getting it right on picking a winner are stacked against you. Of course, there are examples of individuals who are good at it. I've mentioned two already, Charlie Munger and Warren Buffett, exceptional stock pickers. But there's also examples of people out there that can run the 100 meters in under 10 seconds. I'm not that fast, and I'm not that good at picking winners. So really, it's silly for me to benchmark my performance to aim for the performance of literally the greatest to ever do it. I should instead look to play the averages because I am average. Warren's rule on not losing money. Investors need to have a bit of humility here. You might be smart, but it's unlikely that you're smarter than the aggregated intelligence of the overall stock market. And even if you are, you're unlikely to be dedicated in terms of time and attention to really shift the odds in your favour. I think most people have heard this statement, that the higher the risk, the higher the potential return. But do people really grasp what it means? There is no risk-free way to generate a massive return. The higher the return on offer, the more risky the endeavour. Always, every time. For one person to win the lottery, millions of people lose everything that they put in. The reason Warren Buffett and Charlie got so rich is because the reward for those who can pick the best stocks correctly are so high. Why are they so high? Well, because the risk of getting it wrong is so high. Most fail, and the results of failure are massive losses. If you're all in on crypto confident that it will generate you massive life-changing returns, do you acknowledge that this inherently comes with huge risks? And look, I've got Bitcoin, I'm not hating on it. I just understand that this is the riskiest part of my portfolio. There is no massive upside without massive downside. Even sectors that have offered huge returns more recently carried the most amount of risk. The tech sector, which produced the highest returns for investors over the measured period, also had one of the highest proportion of individual company failures within it. Now, we should all take risks. I take plenty of risks, but I take those risks in the sphere of unique competence that I have. Once I found out that I could make finance videos that people like to watch, I quit my full-time job. Pretty risky. I also bought the podcast that I co-owned when Amazon tried to buy it. Again, very risky, but I felt I could do things better than Amazon. These are risky decisions, right? But it's in a field that I believe I am knowledgeable or potentially an expert. So I can drive excess returns through taking risks and applying extra effort. Ask yourself, what areas of my life do I have an edge over others? Then take risks there. Be honest with yourself as well. Is that thing studying, valuing, and picking individual companies to invest in? For me, I don't think directing my limited effort towards trying to pick stocks is a worthwhile thing for my time. In fact, I believe that the more effort I put in, the worse the outcome. In 2013, Fidelity, the broker, reportedly studied its investors over the prior decade. It wanted to see who had done the best. The top performers had one surprising thing in common. They were all dead. Unable to tinker or second-guess themselves, they simply stayed invested and that paid off. For their relatives. It's hard to track down an original source for this story. It's spread all over finance journalism, but I couldn't find the actual study itself, so, take it with a pinch of salt. But I think the lesson is an important one. In investing, it's often counterintuitive, isn't it? Everything in our life, the more effort we put in, the more we get out. Whereas with investing, it's potentially the complete opposite. As Nobel Prize-winning economist Eugene Farmer put it, money is like soap. The more you handle it, the less you'll have. Trading fees will eat into your returns, and market timing, this idea of trying to miss out the bad days, risks you missing the best days, which often come in times of downturn when the market is tanking. If you miss just the 10 best days in the S&P 500 over the last 30 years, your portfolio would have been cut in half in terms of its end value. That's why I buy a global index fund, no matter what the market or news is doing on that particular day. I just keep buying it every month consistently, because it's that consistency that I believe drives long-term returns, not perfect timing. A global index will never be the single best investment of the year. By owning everything, you commit yourself to mediocrity, don't you? You can't be the best investment when you own everything. So I'm always going to miss out, but that's fine as long as that mediocrity gets me to my financial goal. I want investing to be like brushing my teeth, automatic, effortless, and part of my daily routine. Remove any effort, remove any choice, just stick with it. Remove complexity. So I want to speak to you about incentives for a second. So Charlie Munger, our man from the start, he really is full of wisdom.
The basic rule on incentives is you get what you reward for.
If you're a content creator like me and you want lots of views, that incentive pushes you to make negative clickbait content. It also pushes you to make thumbnails where it looks like you've crapped yourself in them. If you're a financial advisor, the incentive is to make people believe that they need you. And if you work in the financial services industry, the incentive there is to sell more products with higher fees. How do you achieve that? Well, you make things more complex than they need to be. The truth is that simple, cheap solutions usually beat complex ones. Sure, there are approaches that backtest better than just buying a global index fund. Maybe you want to tilt towards size and value factors using the Farmer French model. But if you don't understand what I just said, Should you really be buying it? A 2020 paper put it clearly. The rich, sophisticated benefit from complexity at the expense of the poor and naive. They got loads of examples of this in the paper. I'll leave it below for you. But they cited specifically China in 2015, when a series of complex funds that had performed really well and become really popular were restructured, and naive investors didn't really know what was going on. So they sold and they locked in losses. It was reported that the average investor broke even overall, but beneath the surface, the top 1% gained 500 million renminbi. The other 99% lost 500 million. That's a direct wealth transfer. Complexity does not benefit you. It benefits the elite or the industry. Another paper found that complex products earn about 1.7% per year less than simple ones. Your whole investment strategy should be explainable in a few lines that you can recite when you're pissed to your mate at the pub. I buy a global index fund inside of tax-efficient accounts every month regardless of market noise. This long-term consistency lets me capture the general upward trend of the stock market over time while removing the biggest threat to my portfolio, myself. You are, unfortunately, wired to be bad at investing. Evolution gave us traits that were really good at surviving, but hurt us in the markets. Loss aversion means losing feels worse than winning, so you flee when you should be buying. Herd mentality and FOMO push you into overhyped assets, and recency bias makes you believe that what's rising right now will keep going up. So just take the US stock market. In recent years, it's been the most successful stock market on the planet, but between 2000 and 2009, it had what was called a lost decade. I'm not saying US exposure is a bad thing. I think a long-term bet on the US is probably a sensible one, but you need to view the returns, the expected returns over a 30, 40-year period. Because how many people that are all in on America right now would be rattled if they saw a 10-year period where they generated no return? You can't control the market, so control what you can. Eugene Farmer is known for the theory that markets are efficient. This is the idea that at any given moment, all the known information about a stock is already priced in. And that, only black swan events can really shock the market and move the price massively. I don't fully agree with that. I think there are inefficiencies. But I think as an investor, it helps me to think that the market is efficient. It reminds me that there's no easy short-term forecast in the stock market that I can make. There isn't some forgotten piece of information just lying around on the floor that I can scoop up and go, oh, there you go, now I can beat the market. The market is forward-looking, and it's constantly trying to guess what's coming next, and any new information is brought to the market quickly and then priced in fast. They're also a collection of thousands of different companies, all with their own unique challenges and issues day by day. Not to mention markets operate often on pure vibes and sentiment. Just take COVID in 2020. GDP collapsed, unemployment soared, yet stocks roared back in one of the fastest recoveries ever on record. Look, I do think there are opportunities in the market for people that get very specific. So people that might focus on specific markets like the UK market or specific sectors and company types and find undervalued businesses amongst that. But that's just not that interesting to me, to be honest. I would rather spend my time pulling stupid thumbnail faces, it appears. But it's this effort bit all over again. Are you willing to put in the effort required to do the work to make sure that you're the person that discovers the information? Because there are people spending all their labor, all their effort trying to do just that, and beating them is going to be hard. Because even if you do it as well, there's no guarantee of returns. There's no guarantee that it's going to work. And there's other things that you can do that are much easier, much simpler, and they do guarantee better returns. Fees as a starting point. If you invest £300 a year for 40 years and you achieve the average global return of the stock market before inflation of 8%, the difference between the end result, the money you end up with, on a portfolio with a 0.2% fee, a 1% fee, and a 2% fee is ridiculous. This compound interest calculator, as well as my own, it allows you to add in fees and also inflation and things. I'll leave it below for you. But 0.2% gets 926k at the end, 1% it's 742k, and 2% is 568,000. As you can see, small differences in fees can add up to hundreds of thousands of pounds over an investing lifetime. Fees aren't everything, they shouldn't be your sole focus, but they're one of the few things that investors can actually control. That's why I buy low-cost index funds, and it's why I use discount brokers like Trading 212, who charge no platform fees or dealing fees. I link all of the brokers I use in the description of every single video. Some of those links are affiliate links, which means if you sign up to the broker through that platform and deposit funds on the platform, we both get something. So for example, at the minute, Trading 212 do a deal where if you deposit £1 on the platform and use code DAMIEN, DAMIEN, you'll get a free fractional share worth up to £100. And I've marked which are affiliate links and which aren't for transparency. Next is taxation. There's an argument that the main benefit of investing inside of tax-efficient accounts like pensions or stocks and shares ISAs isn't the gains that you'll make from investing, but the tax that you'll ultimately avoid. Nothing is certain in life but death and taxes, so if you avoid taxes, that's a certain return. From 14 years of investing, what I think I've learned is, it's not what you put into it, it's not the effort, it's what you take away. Remove the chances of catastrophic losses, reduce effort and complexity, relentlessly repress taxes and fees, and restrict your ability or the ability of others to influence your decision-making process. I've skimmed over a lot of topics today and I haven't really included everything I've learned about investing in the last 14 years. I mean, what did I tell you about finance creators and clickbait, eh? So here's a playlist of videos that I think you'll find useful to go into this in more detail. And below in the pinned comment is a link to my completely free Index Investing for Beginners course. No upsells, no paywalls, nothing like that. Just me sat there waving my hands around for 2 hours. I hope you enjoy it.